Hi, I'm Audie.
Ever felt like you were right about a stock's direction, but your option trades still lost money? You're not alone.
Welcome to the world of options Greeks. Today, we're moving past the math and into the mechanics.
We're going to look at delta, gamma, theta, and Vega not as scary formulas, but as the gears that drive your trade's price, time sensitivity, and volatility.
Why bother with these? Because the Greeks help you solve the mystery of why an options price isn't moving in tandem with the stock.
They turn guessing into precision strike selection by using delta as a mathematical proxy for probability. Most importantly, they show you exactly when to hold, fold, or roll based on how your risk exposure shifts in real time.
As the saying goes, Greeks aren't about predicting the future. They're about understanding the effect on the premium right now. To understand Greeks, you have to understand what you're actually buying. Every option premium is made of two buckets. First, intrinsic value, which is the real value or the difference between the spot price and the strike price. Second, extrinsic value, which we can think of as hope and time, representing the time to expiration and implied volatility. This extrinsic value decays to zero at expiration, and the Greeks quantify how these two buckets expand or contract based on market conditions. Every strategy is just a combination of three primary forces acting on your premium. First, we have the directional move of the stock going up or down, which is measured by delta and gamma. Next is the force of time passing as we approach the expiration date, which is measured by theta. Finally, there is implied volatility, driven by market fear or earnings events, which is measured by Vega. Understanding how these forces interact is the key to mastering any trade. Let's start with delta. Think of it as your speedometer, a theoretical estimate of how much an option's value changes given a $1 move in the underlying stock. It is also a tool for share equivalency. A 1.0 delta behaves like 100 shares of stock, moving $1 for $1, while a 0.50 delta moves like 50 shares, gaining 50 cents for every $1 the stock rises. For example, a 0.70 delta results in a $70 profit per $1 stock rise. In practice, delta acts as a rough approximation of the percent chance an option expires in the money. A delta greater than 0.70 is a high probability trade that acts much like the stock. A 0.50 delta is essentially a coin flip with a 50-50 chance. If you are selling covered calls, a 0.30 delta implies only a roughly 30% chance of being assigned, while anything under 0.30 is considered a low probability lottery ticket. Next is theta, the daily dollar value lost due to time passing. Using the balloon metaphor, long options have negative theta, meaning the balloon is constantly leaking air and losing value. Short options have positive theta, where you are the one collecting that leaking air as profit. It is vital to watch the decay curve, as time decay accelerates significantly in the final 21 days before expiration. If delta is speed, gamma is acceleration. It is the rate of change of delta. Gamma's job is to force delta toward either 0 or 1, which creates either stability or instability in your position. Looking at the gamma bell curve, the highest acceleration and instability occur when the strike price is at the money. Gamma is a double-edged sword. For buyers, or those with long gamma, acceleration helps you because gains accelerate as the stock rises and losses slow down as the stock falls. However, for sellers with short gamma, acceleration hurts as the stock moves against you. Losses accelerate rapidly. To manage this, avoid shorting options in the final week of expiration, as explosive moves can wipe out your premiums. Then there's Vega, which measures sensitivity to changes in implied volatility. This isn't about the actual price movement, but market fear and greed. Long options have positive Vega because they want IV to rise, while short options have negative Vega because they want an IV crush. While delta usually drives P&L,
Vega becomes the dominant force during binary events like earnings.
Here is your core relationship matrix.
Long calls are positive delta, gamma, and vega, but negative theta. Long puts are negative delta, but positive gamma and vega, and negative theta.
Short positions flip these dynamics.
A short call is negative delta, gamma, and vega, but positive theta. A short put is positive delta and theta, but negative gamma and vega.
You can also net your Greeks to customize your portfolio.
For instance, in a bull call spread, you might buy a 100 call with a 0.60 delta and sell a 110 call with a minus 0.30 delta.
This leaves you with a net position of 0.30 delta, giving you reduced directional exposure and lower risk.
Always check the net to see if you are theta positive for income or theta negative for speculation.
Don't do the calculus in your head. Use a P&L simulator to visualize the future by adjusting the levers for target price, target date, and implied volatility. You can see how price moves are driven by delta and gamma, how the date affects theta, and how volatility impacts Vega. This shows you the curve of profitability before you ever enter the trade. When applying these mathematical concepts to the market, remember that if you are buying options, you should buy time by choosing longer dates to reduce theta drag. For those selling options, the 30 to 45-day window is the sweet spot, but you must close the position before the final week to avoid gamma risk. For strike selection, delta should be your primary driver, rather than the premium. For example, consistently selling 0.30 delta calls keeps you focused on price probability. Ultimately, price and delta are king, so don't obsess over Vega if you get the direction wrong. To conclude, moving from math to mechanics means asking the right questions. Am I bullish or bearish? Is time helping or hurting? Is my position stable? And is fear rising or falling? Use the Greeks to read your dashboard and understand the effect on your premium right now, rather than just watching the scenery. Just remember, options involve risk and aren't for everyone, so treat this as an educational guide for your financial journey. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.